Now, before starting the second part of the video, if the content helped you in any way, which I'm guessing it did since you're watching the second part, it would help me a lot if you could like and subscribe to my channel. Thank you very much. Let's begin the second part. Okay, great. Now, equity securities represent a claim on the earnings and assets of a corporation. Equity securities are also called stocks, shares of stocks, or shares. And as I mentioned earlier, shareholders, also known as stockholders, have ownership in a company. They essentially buy a piece of the company. If the company profits, the investor profits as well. But if the company loses money, the stock also loses money. Now, if you buy shares, you expect to earn a return once you sell your shares at a higher price than you bought. And sometimes you can earn an income without even selling your share by receiving dividends. What is a dividend? A dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, it is able to pay a proportion of the profit as a dividend to shareholders. Now remember, not all companies pay dividends, and no laws require them to pay their shareholders dividends. And normally a company that is still growing, usually won't pay dividends because, it wants to invest as much as possible into further growth. Now, mature companies, on the other hand, with stable earnings, will normally choose to pay a dividend to make it more attractive. Now, an investor's total holdings of financial assets is usually called a portfolio. All right, now that we know what securities are, where can we buy or sell securities? Where can you buy Apple's or Google stock, for example? Where can you buy bonds? You can't just, walk up to someone and say, could you give me some bonds, right? So you go to financial markets, which broadly refers to any marketplace where the trading of securities occur, including stock market, bond market, forex market, stuff like that. Financial markets play a very, very important role in terms of allocating resources and creating liquidity, and make it easy for buyers and sellers to trade their financial holdings directly. And creating liquidity, meaning you can find a buyer or seller quickly with a fair price. Now, to understand liquidity, let's use an illiquid example. If you want to sell your house, it will likely take some time to sell, right? Some assets, such as real estate, land, and buildings, are inherently illiquid. If you want to sell your house quickly, you may have to sell it at a lower, price than you think it's fair. So financial markets can create liquidity. Financial markets also attract funds from investors and channel them to corporations and help them achieve growth and expansion. Financial markets could be broken down into different types. The main types are stock market, which provide financing through issuance of shares and common stocks, and trading stocks. Also bond markets, commodities markets, and the forex, foreign exchange market, which is the market where we can buy and sell or exchange and speculate on currencies, among others. So there are organizations that facilitate the trade in financial securities. This may be a physical location, such as the New York Stock Exchange, NYSE, where trillions of dollars of securities are traded daily, or an electronic system, such as NASDAQ. By the way, most trading of stocks takes place on an exchange. Now, when providers and users of capital interact through financial markets, it is called direct finance, because the providers of capital have direct claim on the users of capital. But they can also interact indirectly through financial intermediaries. Now, this process is indirect finance because financial intermediaries act as middlemen between savers and spenders. A financial intermediary is typically an institution that facilitates the channeling of funds between lenders and borrowers indirectly. That is, savers or lenders give funds to an intermediary institution, such as a bank, and that institution gives those funds to spenders, borrowers. This may be in the form of a loan or mortgage, and because many savers do not have the time or the expertise to identify and select individuals or companies and governments to lend to or invest in. So a financial intermediary does this on their behalf. Now, in terms of financial intermediaries, the common types include, commercial banks, investment banks, stockbrokers, pooled investment funds, and stock exchanges. And, both direct and indirect ways are important because, in case of indirect, they can perform better and more cheaply than most investors can do on their own. Okay, so like I said, the common types in terms of financial intermediaries and financial markets are commercial banks, investment banks, stockbrokers, pooled investment funds, and stock exchanges. I will try to explain each of them briefly. And, we mentioned that both direct and indirect ways are important because, in most cases, they can do a better job than we can do on our own. Now, before discussing the types, let's take a look at this table, which we already talked about, somewhere at the beginning of the course. But just to refresh your memory. And as you can see, the table illustrates where, financial intermediaries and markets fit in the relationship between lenders and borrowers. And again, we can see in terms of lenders, we have individuals, companies, and banks. And in terms of borrowers, we have individuals, again, companies, central governments, public corporations. So we can see they can play both roles depending on the situation. And we can see clearly that the financial intermediaries and financial markets are in between the lenders and borrowers. Now, let's talk about the financial intermediaries a bit more, particularly, banks and insurance companies. And we will get to these guys later. So, under financial intermediaries, we have financial institutions. And their role is to collect money from savers and, to invest it in financial assets. And the two major types of financial institutions are banks and insurance companies. So banks collect deposits from savers and transform them into loans to borrowers. So they indirectly connect savers with borrowers. And again, indirect because, the savers do not have a direct claim on the borrower, but they do have a claim on the bank, through their deposit. And the bank has a claim on the borrower through, the loan. Now, if the borrowers default, meaning they won't be able to pay back the loan, the banks still must pay their depositors and other lenders, if the bank cannot collect enough money from their borrowers, the banks will have to use their own capital to pay their debts. Now, you would think that the risk of losing capital should focus the bank's attention so that they do not offer credit foolishly. But I don't know if you can remember the financial crisis of 2008 and what caused that crisis. And by the way, in case you do not know, that's exactly what happened. Anyway, banks vary depending on who they serve and how they are organized. Retail banks, for example, provide banking products and services to individuals and small businesses, like checking and savings accounts and debit and credit cards and mortgage and personal loans. Commercial banks is also a type of financial institution that again accepts deposits, offers a checking account, and also makes business and personal loans. Also offers financial products like certificate of deposits or CDs. And by the way, a commercial bank is where most people do their banking as opposed to an investment bank. And in case you were wondering, the difference between retail banks and commercial banks is that in terms of loans, retail banks make loans to their retail and business customers. Commercial banks make loans to enable businesses to grow and hire people. So they're contributing to the expansion of the economy. Now, investment banks specialize in providing services designed to facilitate business operations. Investment banks are hired to facilitate deals between corporations and institutions, such as capital expenditure financing and equity offerings, including initial public offerings, also called IPO. We will talk about it later in the equity section of the course. But just to explain it briefly, an initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Anyway, like I said, we will see it later in different section of the course. Now, investment banks also specialize in mergers and acquisitions and other corporate restructuring. And the big ones are like Goldman Sachs and JP Morgan.